Today, we're going to discuss stock warrants. We'll start by developing an understanding of what a stock warrant is and how they differ from stock options. Next, we'll describe some key advantages that buying warrants offers investors. Let's get started. As you may know, an equity stock option is a contract between two people that gives the holder the right, but not the obligation, to buy or sell a stock at a specific price prior to a specific date, referred to as the contract expiration date. In this case, the option is issued by another investor or institution. On the other hand, warrants are slightly different. A stock warrant gives the holder the right to purchase a company's stock at a specific price and at a specific date. A stock warrant is issued directly by the company concerned. So when an investor exercises a stock warrant, the shares that fulfill the obligation are not received from another investor, but directly from the company. You may ask yourself, what are the benefits of buying a warrant versus an option? Allow me to explain the three main advantages. Firstly, warrants offer high returns in the long term. A major advantage of warrants is they generally offer a longer-term investing perspective. This implies that investors can wait several years prior to buying the shares underlying the warrant. Second, warrants are a low-cost alternative to standard options. The warrants are usually more economical than the shares. Warrants also offer an alternative investment option to standard stocks. This can enhance the diversity of investments and enable investors to make a profit from more dynamic circumstances of the market. And the third advantage is the improved capital management that warrants offer. What this means is that the investors can manage their capital assets better by accumulating with gradual increments instead of right away by margin or credit.
Do you find this video interesting? Hit the like button, subscribe to our channel, and ding the notification bell to stay up to date on our latest upcoming videos.
Next, let's discuss the 5 different types of warrants an investor can buy. The first option is callable warrants. A call warrant guarantees your right to buy a specific amount of shares at a specific price. It also has a predetermined expiration date. The second option is naked warrants. Naked warrants allow the holder to exchange the warrant for a security. They're not tied to a preferred stock or bond. The third option is covered warrants. Financial institutions, not individual companies, issue covered warrants. They allow the holder to buy or sell a certain amount of securities at a predetermined date. These could be stocks, currencies, or other financial instruments. The fourth option is wedded warrants. Wedded warrants come with bonds attached. Investors buy and sell them together. If the holder wants to exercise the warrant to get their stock, they must also sell the bond. The fifth option is traditional warrants. A traditional warrant is usually attached to a bond. This allows the bond issuer to provide a lower coupon rate. Holders can detach these warrants from the bond and sell them on the secondary market. Now that you know the benefits of warrants and the different types that exist, you may be asking yourself, how do I buy warrants as an investor? Great question, and I will walk you through the process now. You buy stock warrants the same way you would buy common stock. Stock and warrant tickers exist side by side on the exchanges. The warrants will usually have an extra letter on the ticker symbol. Take DraftKings Inc., NASDAQ, DKNG. When the company went public, it issued both common stock shares and warrants. The common stock shares traded under the ticker DKNG, while the warrants used the ticker DKNGW. They later delisted the warrants, but many holders had done quite well by then. The best way to buy stock warrants is through your broker, but not all platforms are equal. When you exercise a warrant, you'll need to use a traditional platform like Schwab or TD Ameritrade. Not all brokers currently support warrants. If you want to trade warrants, it's smart to research which brokers offer them first. A great broker gives access to a variety of instruments.
To give you a more practical example of a company's warrants, we're going to take a look at Blink Charging. So here we are on their website, blinkcharging.com. And what this company does is that they design, manufacture, own, and operate EV charging stations, just to give you an example. So let's take a look at this company's equity on Yahoo Finance. So as you can see, Blink Charging trades on the NASDAQ with the ticker BLNK. And currently the stock is at about $31.50. So let's take a look at this company's warrants. So if we just go over here, we can see that the warrants also trade on the NASDAQ under the ticker BLNK with a W at the end. And the warrants for this company currently trade at around $26.60. So you may be wondering, how can I go about buying warrants for this company? Well, there's two options that we know. One is using Charles Schwab, and here you can make an account and log in. You can also use TD Ameritrade, and similarly, you can also make an account and log in here. But if you're already with an existing broker, what you can also do is call your broker and ask them if they allow the trading of warrants on their platform. And if they do, that's great. Otherwise, you can look for another broker in your area that offers the ability to trade warrants.
Let's summarize our discussion on warrants. Warrants are advantageous for both the issuing company and the investor as well. It provides a source of finance to the companies, saving them from financial adversities. Besides, it also acts as a good profit-yielding tool of the investment option for investors seeking long-term gains. Thanks for listening, and be sure to check out our other videos on financial topics.